So thanks everybody for staying with us. We're going to be talking about navigating the rate curve with the U.S. government bonds. Eric talked about earlier that so much money has gone in to government securities, and that's why we want to talk to two of the experts in this space, Alex Morris, who's the CIO and president of FM Investments. Alex, good morning to you. How are you?
I'm fine, thanks, Todd. Thanks for having me.
It's a pleasure having you as well. And we also have Joanna Gallegos, who's a co-founder of BondBloxx Investment Management. Joanna, thanks for joining me.
Thanks for having me, Todd.
It's our pleasure. So we've got a poll up for the audience to, as we did earlier, to touch on, to get an understanding. How do you plan on changing your allocation to government bonds in the next 12 months? Do you plan on increasing your allocation, decreasing your allocation, or maintaining your current allocation? And Joanna, while we give the audience a chance to be able to talk about that, what's the appeal of owning treasuries in this current environment?
Yeah, as we just heard from your last speaker, short-term treasuries have been a great cash alternative for investors from last year. Over 60% of the flows in ETFs in fixed income last year were treasuries. So they've really been about capturing as much yield as possible in this environment as interest rates have been steadily climbing. But investors, we believe, just shouldn't overpay for this exposure. You should be capturing as much yield as possible. So while yields are high, if you're using treasuries as a cash alternative, we think that's great. Why were they using it? As we said, it's really hard to walk away from over a 5% risk-free yield. And we're kind of seeing that we're entering the second half of 2023, and those flows are still, really strong. The first half of 2023 saw, again, 60% of flows going into treasuries. But in July, only 25% of flows are still going into treasuries. So we may be seeing a tale of two halves here, and we think it's going to be really interesting to see what investors do next.
So Alex, let me get you in on this. What's your case for treasuries? Why now?
Well, I think David pointed out the simple case is you're going to harvest yield, just as Joanna said. It's a risk-free investment in that sense. And I guess the other question for advisors would be, well, why would I use an ETF to do this? Can't I just buy treasuries on my own? And the answer is certainly you can. It's tough. And if you're, as an advisor, you have other things to really focus your day on. So it's how do you get exposure to the treasury market in a way that's simple to do, your clients are happy with, and helps you really tell the story of the asset allocation that you've crafted. And I think what we've launched in the benchmark series, what Joanna and team have created as well, point out a need for more specificity. And now as an advisor, you have that tool set where you can really bring to all of your clients the same thing that institutional managers have been driving to institutional clients for a long time, which is that super scalpel-like approach to how do you slice up the yield curve. I hope, Todd, we get the results of the last poll and that say that everyone's looking to still increase to us. But I think I'll take a neutral winner as a good win for today.
Yeah. What's exciting to me when we see the results of this is more people are planning on increasing than decreasing. A healthy stake of government bonds, and they've got a nice stake overall, but more people are looking to add to it as opposed to take money off the table. So you touched on this, Alex, a moment ago, but maybe you just want to expand. What's the benefit of using an ETF instead of just buying a treasury bond directly?
We've only got a few minutes, right? But I'll try my best to get it in. Buying bonds is a well-established process, right? And it hasn't really much changed in the last 200 and some odd years. We've made it faster through electronic means, but at the end of the day, it's still relatively hard to do. It's not as simple as putting it as a ticker. And on the back end of it, because there's no exchange that actually is helping make all this happen, if you're an advisor and you go to Schwab or Fidelity or Pershing and you start looking for a bond, you're really hoping that either the desk has it or they're able to go and get it. And that has all these embedded costs and commissions that aren't always fully disclosed, and it's tough to do. And then you got to hope that all of it works out and it settles. And at the end of it, your client asks, well, you just spent a lot of time doing this. What did you really get me? And the answer is, oh, that thing I told you I was going to do. And they're then going to ask, why wouldn't I just buy this ETF that they've seen? So it answers a lot of that. And then the other major benefit of the ETF is our ability as portfolio managers and ETF issuers to help eliminate capital gains through effective management of the product. And on the way up for rates for treasuries, not so big of a problem. But on the way down, when, particularly in the longer duration assets, when we're able to give you a lot of price appreciation, but now without any capital gains, clients are going to be really excited about that.
So, Joanna, I'd love to get your take on this. Obviously, you have a long history of within the fixed income ETF marketplace. Why using ETFs to get treasuries?
Well, I think it's some of those same features of convenience and workflow for a lot of investors, so they can maintain their exposure in a consistent way. But when we look at the space, we actually saw that every ETF in Treasury space that was launched before the BondBloxx ETFs were launched actually had, two main problems. And that was, the costs, the pricing hadn't been updated for a long time. So again, as I mentioned before, as yields were rising, it's a really great place to capture this historic moment in rates. But we wanted to make sure we updated the pricing there. And then the other is that in these portfolios, duration can fluctuate, quite significantly. And, we talk about the tools that active managers are using and the strategies that they're using. And again, in our past guests, we heard that duration is a really important process that investors in fixed income are trying to manage. So we came at this differently and intentionally to update the pricing so we were the most cost-effective suite of Treasury ETFs. And then as well to, as Alex mentioned, make the products more precise. And we were the first ever to target duration. So we intentionally designed them to be duration focused so that asset allocators can measure their interest rate exposure. And, in order to do that, you need to have more than one bond in your portfolio. And it's really important, as you go further out the curve, that you have a precise approach across the yield curve, like institutional investors do, especially if you feeling that, interest rates are going to change. So, we think there's a lot of Treasury ETFs out there. We think the space is really well used by ETF users, but it needed to be updated significantly. And that was our perspective when we entered the market last year.
So, Joanna, you talked about being precise. That's one of the great things about the products that you and Alex both offer. Where are you finding within the yield curve that investors are most interested in?
Yeah, we're certainly, as we discussed before, seeing things on the short end of the curve. But in recent weeks and in recent cycles, we've been seeing people move a little bit out of the curve. And I think that reflects certain investors that think, a recession is coming and interest rates may decline in a period of time. And, if that's your view, it makes sense to take some steps out on the curve on the Treasury side. If it's not your view, and actually we maintain at BondBloxx, there's probably very little chance in 2023 that the recession is coming, I actually think you should be considering credit and moving, further away from Treasuries, given how stable and resilient the financials and the balance sheets have been in credit. And, moving up in quality or moving up the cap structure is an interesting approach, as we talked before. But just being to have access and thinking about credit in a diversified, systematic way, it's something that I think that investors now have and should be thinking there as well.
So, Alex, what about you within the Treasury side of the market? Are you seeing the focus has been on short term for most of the year?
Certainly, the flows have indicated that. Folks love to harvest yield. Can't blame them. Why wouldn't you take some T-bill or U2 and just take the short end of the curve and clip 5 or almost 5 in the case of the 2-year on a regular basis? It's nice and easy. But we have also seen folks start to take some of those proceeds, reinvest into longer duration assets, right? And I guess the key to the benchmark series is we hold that one bond. It's the one bond that the institutional investors add when they're trying to control for duration or control for maturity, which is why we did it. It's a very thoughtful implementation of simple. It's what we do every day as an institutional manager. And it's how do folks do that? And as we watch folks unwind into duration, we find that we bump into parts of their credit portfolios. And we're really thrilled to get those phone calls and help folks really target in what is the end maturity they want, knowing that when you buy, say, U10 or U5, you get the thing that you see on TV. You get the rate at the most recent auction. And you're ultimately plugging in that part of the portfolio because your actively managed credit exposure, you're paying someone good money to help move that duration around to help fit the view that they have. But that doesn't always match with the view that you have as an advisor or that your clients need. So we're really happy to give folks that tool set, particularly as we go to longer end assets. We also always see some action at the farthest end of the curve. And I think that's just deep down, there's some portfolio managers like us. You spend any time trading bonds, you become either a curve nerd, as Dave Nadig well put it, or a duration junkie. And that's why I think we see some folks in the far end. And certainly that's where some of our portfolios are starting to tend. But I'd say if you were to look out the rest of the year, we're going to see a gentle unwinding towards that sort of middle end of the curve, that 3-year space that David talked about earlier.
So, Alex, you touched on the middle of the curve, and we certainly saw for folks that were on for the first segment where we asked the expectations, are we going to see higher or lower? And of course, David Pimko pointed out it matters what you're looking at. So 6 months out, where do you think we're going to see a greater focus within your lineup, Alex? Is it going to be in that intermediate end of the curve?
I would think we're going to start to see flows accelerate there. They may not outweigh just the short end of the curve, given it's already much bigger space and more developed, certainly in our series. But I think you're going to see 3 and 5 years, 7 years start to really pick up. And the one fund that probably gets the most action is the 10-year, just because so much of the global financial infrastructure is based off the 10-year. Everything from your mortgage to your car loan to everything in between starts to function off of that. And for a long while, there's just been less interest in that duration. But the 4 years sitting between that 3.5, 4.5 range that David talked about feels like a great place to get a nice coupon return, as well as have some price appreciation if and when rates start to fall, which we really needed on the first pull, option C, exactly where we are right now. And I suspect most everyone would have picked that, not because it's easier, but we've probably got a rate hike or two in us. And then, so looking a year out, maybe a little teeny cut, if not some consistency in staying at that rate. The Fed's made a good point about higher longer, which means you do have an opportunity to clip some coupons at the front end of the curve. But if you're going to start to move out, you probably want to be in some of the key benchmark tenors where there's going to be the greatest price action.
So, Joanna, I think I heard you say there's no expectation or BondBloxx doesn't expect a recession. But what do you think from the focus is going to be 6 months out? Do you agree intermediate term, or do you think people are taking longer term?
We see people going into intermediate treasuries today and longer. We've seen some pickup in trades recently in the last week or two. But, in this environment in the first half of the year with yields at 4 to 5%, it made sense to focus on treasuries. And if you, again, look out and you think a recession is coming, then, as I said before, you should probably extend out on the treasury curve to capture the total return from potentially declining rates. But if you don't, we just think that people should be looking at opportunities in credit. And that's an area that is long sort of, I think people have maybe gotten that trade wrong over the last year or so, and with good reason, as there wasn't a lot of certainty going forward. But we do think that there's another way to access quality in fixed income. And we think people should be looking at the different cuts of fixed income and having their ability to do that. But, for the time being, the flows are still very strong in the short end. And we've seen most interest in X-half and X1, which is our 6-month and 1-year treasury for now. But we're really interested to see how the second half of the year shapes up.
Joanna, I have one of the tickers that you referenced up, X-half. We also have T-bill from FM team, and we'll show X1 in a second. But we touched on this, but I just want to dive a little bit deeper as to why own a 6-month targeted Treasury ETF or a 3-month instead of owning an iShares or a Vanguard ETF that covers multiple duration periods.
Yeah. So first is cost. Like when you are taking yield and you're running after that yield that is just so available in this market, we really think and thought that the entire suite and product line in Treasury ETFs needed to be updated. So X-half is 3 basis points. You get to keep as much as possible that yield as you can. There's obviously the workflow that Alex mentioned. Like it takes time and energy to roll Treasury forwards and maintain that position, and you should let someone do that for you. ETFs have been doing a great job of that for almost 20 years in Treasuries, and I think it's a really simple tool to incorporate into your Treasury management. And I think when you think about the Treasury products, they can offer a really solid base for a portfolio of income right now and stability. But as you're thinking about what's next and whether rates are going to be higher for longer or you're looking for declines, I think the whole suite and the options that you have are going to be very different this time in this market around, because you can move around with a lot more specificity. So we think that, it's been good for these two firms to come and bring their products to market. So investors have a lot more choice than they did before, and someone's paying attention to their current needs.
Hey, Todd,
Alex, go ahead, please.
If I could add on to that, I think, the reason why Joanna and I are here, and if you'd asked both of us, given us the true serum 18 months ago, would we be talking about short duration assets, or in particular Treasury assets? We tell you no. It's really just the fact that whether you see it in the short-term flows, long-term flows, ETFs based on fixed income are a smaller part of the market. And for a long while, rates were choose your flavor of zero, and it was truly uninteresting. Hence, there was no innovation. And now that there is a material return across almost the entirety of the fixed income spectrum, and the ETF has matured to the point where now it's accepted, it's easy to use, it's a no cost, no commission trade often. You can put it in a rebalancer, which you can't do with a CUSIP whether it's a Treasury or a corporate debt item. All of those came together at the right time. And sure enough, the capital markets are doing exactly what they're set up to do. Bring in innovation, whether that's, the two things that you see, you two and the other suites that have come out today, or products from everyone else. Plus, on the back end of it, the indices that track Treasuries were just not particularly interesting for a long while. They tended to follow and be built around how the U.S. government issued its debt. And that was really an accounting practice the government had to adapt and adopt. So it created it. Bond issuers followed it 2-3 decades ago because it was easy. But I don't think any of us turn to Uncle Sam for our investment theory or how we should invest in the curve, or certainly how we should allocate our clients' portfolios. So as a result, with no yield, kind of uninteresting strategies, all of a sudden add yield back in the equation and then add innovative firms out there. Now all of a sudden you see a whole raft of new and effective product coming to the market.
I would certainly agree with the innovation standpoint. So final question for you before we then transition to the next panel. How are you finding advisors using your ETFs in a more diversified portfolio?
So we find that one, for folks who have cash, particularly those who can't bill on cash, are bringing in the short end of the curve as a cash alternative, and then starting to vary some of that duration based on client need. We also find folks who have a credit exposure today and are unhappy or have a view different than how their credit manager has gone about it, start to put in some of these at ends of the barbell to help adjust that duration or maturity or change the coupon experience that they're getting. And then finally, folks have come in, many advisors have really wowed us with the diversity of where they want to be on the Treasury curve. They have an exact view. We want to articulate it. We have a lot of folks telling us that they've shorted the funds because they thought rates would continue to rise and they wanted to benefit from that, which was almost impossible to do in the native cash bond market, but easy to do in the ETF market. So I'm really excited with those sort of three items. Long term, though, I think we'll see that all Treasury funds are going to be a bedrock portfolio, particularly as rates stay off zero for the near term. And whether that's 2% or 10%, it's going to be there to generate some yield and add some stability, which is what ultimately the funds are designed to do and what the Treasury markets will look to deliver.
So thanks for that, Joanna. I'm getting a 2-minute warning to transition to the next one. So let me give you the final word on how should an advisor use your ETFs.
Yeah, quite simply, to simplify the duration management process. They enable investors to manage duration without the complexity of monitoring for duration drift and executing rebalances themselves. And our funds, rebalance to give you a consistent duration every single month. So you can always count on what it says in the name. It does. And with 8 products across the curve, investors have the ability to customize their exposures exactly as they need to. And that enables them to be precise with single points on the curve versus products that have wider maturity bands. So, and I've said it a couple of times, we really believe fundamentally that Treasury exposure should be low cost. And we've updated that pricing that hadn't been updated for 20 years. And so they're priced attractively. So that's what we think is the most important thing, is to make sure that, that fluctuating duration is solved for in this environment. And as well, you're getting everything you can out of the efficiency of the product from a cost perspective.
I couldn't agree more. So Joanna, Alex, thanks a lot for sharing your expertise with us and with the broader audience.